Hello, my name is Elliott Gue. I'm editor of Personal Finance, the Energy Strategist, and a brand new product called Stocks on the Run. Today I want to talk about a couple of different areas in various sectors that I think are promising here over the next several months. First up, I want to talk a little bit about refining. Now this is an industry that is very much misunderstood by most investors, and it's also been an industry that's been extremely depressed for a long time now. Basically what refiners do is they take raw crude oil and they process it into usable products like gasoline, diesel fuel, and jet fuel, kerosene. They don't really profit from rising oil prices. In fact, that's actually a cost for them. Higher oil prices means that they pay more for the feedstock for their refiners. What they really profit from is the differential between the cost of crude oil and the value of refined products like gasoline and diesel fuel. Now the problem over the last year, especially with your US and European refiners, has been that differential is really closed. This is called the crack spread. It gets that name because you're actually taking a barrel of crude oil and cracking it to make products like gasoline and diesel. What's really happened over the last year is that the price of oil has risen a lot more quickly than the price of gasoline and diesel, crimping those profit margins. The other problem they've been facing is due to the recession and the drop-off in energy use. Really, gasoline demand has been weak in the United States, gasoline demand has been weak in Europe, as has diesel demand. So not only are they seeing weaker profit margins, but they're also seeing weaker throughput volumes through their refiners. We've seen this really across the board. There are a number of independent refiners in the United States, which is basically all that they do. Companies like Valero Energy, symbol VLO, they've obviously gotten crushed by this. Other companies like Chevron, Exxon, and your other big oils typically do refining as part of their broader business. So they really have two major business lines, exploration and production and refining. Now the exploration and production side of that business has been quite strong, primarily as a result of higher oil prices over the last year. The refining business has been terrible, and it's really kind of obfuscated some of the gains that they've had on the E&P side of the business. So where do we go from here? Well, what we're seeing is a very healthy closure of capacity in the United States. In other words, refiners, noting that there's too much refining capacity out there, are actually closing down some of their refineries, idling refineries, to try to cut back on that supply and really firm up profit margins. I think it's going to take a number of years before we see this business really turn around and get back to the kind of profitability levels that we saw a couple of years ago. I think it's going to require somewhat of a rebound in gasoline demand and other refined products demand in the U.S., probably a cyclical rebound in demand as a result of an improvement in the economy, coupled with further closures of refining capacity. However, I do see a trade here developing over the next 6 months or so. Really what we typically see this time of year is starting in sort of the late winter, moving up until the late spring, you typically see a seasonal rebound in refining margins. And the reason for that is because a lot of refineries are brought offline ahead of the summer driving season. So I think what we're going to see this year is some better news on the demand front, where we'll see probably consumers use a bit more gasoline this summer than they did last summer, coupled with a normal seasonal rebound in profit margins. So short term, I do see some upside for the refiners. Longer term, I think they're going to be troubled for quite some time to come as a result of excess capacity, excess refining capacity, and of course still pretty weak demand. Thank you very much.